Morning. To start with, I have a few housekeeping items. If you have questions while we are presenting, please type them in your Q&A feature at the bottom of your screen. We will be answering your questions at the end of the presentation. If the questions go long, we will stay on to answer them. Please feel free to leave if you have another engagement to get to. This session is being recorded and a link will be sent out to each of you in the next couple of days. I am Andrea Thermos, a partner with Boulet's Estate and Trust Department. I joined Boulet 10 years ago and was promoted to partner in June of 2021. I have over 20 years of experience in the estate and trust world, with my primary focus on tax compliance and planning as it relates to estates, trusts, and gifts. I serve on the MNCPA task force for the Estate and Personal Financial Planning Conference, and in my free time, I love to experiment with new recipes and entertain friends. Today, I'm being joined by Emily Blackburn. She joined Boulet in 2013 and has been a senior manager since 2020. She specializes in estate, trust, and gift tax compliance, comprehensive estate plans, and probate and estate administration, including asset management and trust funding. She draws from her education in both accounting and law to be able to provide a variety of services for her clients. In her free time, she enjoys all types of outdoor activities with her family and friends, sampling all the desserts she can, and spending time with the joy of her life, her daughter Winnie. In Boulet's Estate and Trust Department, we assist clients in all stages of life. Through a holistic approach to estate and trust planning, we take into consideration the different objectives you have throughout your life, and when it comes to retirement planning, charitable giving, and care for loved ones. We strive to develop an estate plan tailored to your objectives, giving you confidence in the future of your estate. This morning, we are going to give you some insights about the basics of irrevocable life insurance trusts and how they can be used as part of your estate plan. Take it away, Emily.
Thank you, Andrea. So to get started, I just want to touch on some of the basics related to irrevocable life insurance trusts, or ILITs, as we will be calling them for short. There are a lot of, as with all trusts, a lot of different shapes and sizes that these can take, but we are going to try to touch some of the main aspects of them. It's definitely not a one-size-fits-all scenario, and so it will be very fact-based depending on your specific goals and estate size and things like that. So keep that in mind, and we will do our best to answer questions at the end as well. So first of all, typically an ILIT is a trust created during the insured's life to own one or more life insurance policies. These trusts can be structured to hold single life policies or second to die policies. They can also hold other types of assets besides just life insurance policies. So it really just depends, again, on what the goals are of the grantor. Because these types of trusts are typically structured as irrevocable, that means they cannot be modified easily like a revocable trust can. In order to modify it, you may have to involve the probate court or get a non-judicial settlement agreement, which would require agreement from all the interested parties. And so it's not something where you are retaining control over the assets within that ILIT. And as you'll see later, that's on purpose. It's so that we can get some of those estate tax savings benefits with this type of structure. The typical roles within the ILIT will be similar to all trust agreements: the grantor, which is the person creating the trust; the trustee, which is the person or institution responsible for administering the trust, controlling the assets, making sure everything that is provided for in the trust agreement is happening. They can certainly hire agents and various professionals to help them do so, but that is the role of the trustee. And then the beneficiaries are the people named in the agreement who have an interest in the trust and will typically receive those insurance proceeds upon the death of the insured. A few important items related to these roles: the grantor cannot be named as trustee of this trust. And the reason for that is, again, we want to prevent estate inclusion for estate taxes oftentimes with these trusts. And if the grantor is also named as trustee, it's going to give them too much control retained over that policy within the trust, too many incidents of ownership, as the IRS likes to define it. So the grantor cannot be the trustee, but pretty much anybody else can. The spouse can be in certain circumstances. Again, this kind of depends on who the insured is, how the trust agreement is drafted, because again, we want to make sure that any provisions included in that trust agreement are going to prevent that value from being pulled back into the spouse's estate as well. So lots of things to consider there. And it's also important to note that if a spouse is also a beneficiary of the ILIT, it's generally best not to make gifts out of a joint account to, again, avoid that estate inclusion. So just a couple of things of note there related to the various roles within that trust agreement. So next, let's cover some of the primary benefits and why we see clients typically opting to create this life insurance trust. One of the main ones is that estate tax savings. It allows the grantor to remove the value of that from their estate for estate tax purposes, while still providing that support for the beneficiaries named in the trust. There's a common misconception that life insurance is not taxable. And while that is true for income tax purposes, it is includable in the decedent's estate for estate tax purposes. And so this is a vehicle that can be used to kind of get the best of both worlds of getting it out of the estate, but then still providing that support that you want to for your loved ones. Again, the way that works is to create the incidence of ownership that the grantor is not retaining. And so they cannot, change the beneficiaries on the policy, borrow from the policy's cash value, modify the policy. That takes all of those ownership rights away so that it can get it out of that grantor's estate. So there is limited control. So that's something to definitely consider with these types of trusts. But oftentimes we find that, clients' benefits for setting these up outweigh some of those other options. Another important reason that clients often set up ILITs relates to liquidity for the estate for estate tax purposes. We often find that clients end up having assets included in a decedent's estate that are illiquid, or just items that the beneficiary does not want to sell, whatever reason that may be, if it's a closely held business interest or real estate, things that are not, easily converted to cash to pay that liability of the estate related to estate taxes. So an ILIT can help solve this problem by including certain provisions within the trust agreement that allow that estate to receive a loan from the ILIT, which allows them then to have that cash available, or to sell assets to the ILIT in exchange for cash. So, it provides a little bit of that flexibility there and gives the trustee and the, personal representative of the estate some options to work together to help provide that liquidity. It's important to note, though, that the ILIT should not, just directly pay those estate taxes, because that could cause, again, those assets to be pulled back into the grantor's estate. So making sure that those provisions within the trust agreement are followed properly and the transactions, occur according to how they are written in the document. Some other benefits: creditor protection. Because this is an irrevocable type of trust and it doesn't give ownership directly, it can help provide protection for beneficiaries, related to bankruptcy, divorce, other creditor issues, while those assets remain in the trust. Once the insured has passed away, proceeds are distributed, and if proceeds are then distributed out of the trust to beneficiaries, that asset or that creditor protection is lost. But while all of those assets or those proceeds remain within the trust, it can keep those assets from being reached by beneficiaries' creditors, which is very helpful in certain circumstances, especially, when people have young children, they may not know what to expect down the line. This can can provide that extra level of protection. And not listed on the slide, but maybe a little bit more obvious, but since the assets of the ILIT are no longer, belonging to the grantor, the ILIT is the owner of this policy or the assets in the trust. It can help prevent the grantor's creditors reaching those assets too. So that's another way that it can offer creditor protection. One of the final big ones is asset management. It can help provide a centralized management of these assets. It states the grantor's objectives basically within that trust agreement as to timing of distributions to beneficiaries. Is it going to be upon obtaining a certain age, or related to certain life circumstances, or just for their support? However you want it to be drafted, it's really flexible in that way. But it can provide, again, some provisions in there relating to how that grantor would like these assets to go to their beneficiaries without having them retain enough control that it's then included in their taxable estate. So again, sort of the best of both worlds in that scenario. There are a couple of, downsides or at least considerations that you want to take into account when deciding if this is an appropriate structure for you. One of the big ones that I've already mentioned is loss of control over the assets. If that is a concern, if there are certain assets that you want to really retain ownership of, really be able to say what's going to happen, you don't necessarily want to put that asset in this type of trust because you can't retain that control. If you do, it's going to cause that estate inclusion, which kind of defeats a lot of the purpose of the trust for many people. Changed circumstances could also, make an ILIT unattractive. Again, because it's irrevocable, there's some flexibility you can build into the trust document for, unforeseen circumstances, but obviously not as much as would be available had you owned that asset outright as an individual or in something like a revocable trust. So that's just another consideration. And then finally, just the additional cost of drafting, funding, and the ongoing administration of the trust. That, may make it a hurdle for you depending on your estate circumstances, your goals. So it's really important just to make sure that you and your professional advisors can outline what you're trying to do, what your hopes are, and really go through kind of the different options and whether this, as a general strategy is right for you. And then if so, what should that actual agreement and policy and various other assets, et cetera, look like to structure this out fully. So Andrea is going to now go into more detail on some of the administration that I referred to and the funding, and then other considerations to weigh when determining if this will work for you.
Thanks, Emily. So I'm, as Emily mentioned, I'm going to talk about what funding can look like, and then some considerations beyond that would be considerations as part of your estate plan, but not necessarily specific to the ILIT structure overall. So funding, when your ILIT is established, it can be funded one of two ways. It can be funded with a new policy or through an existing policy, and they each have their advantages. And I would say that a new policy is probably more advantageous. Basically, the grantor is contributing cash to the trust. The trustee is then purchasing a new policy. When they do that, they're purchasing it with funds from the trust, and the owner and the beneficiary of that new policy would be that insurance trust. With an existing policy, it can get a little trickier. It's absolutely possible. It's the same kind of thing. You're making a gift of an existing policy to that newly created insurance trust. You want to make sure that when that occurs, that the beneficiary designation is changed and that the ILIT is named as the new beneficiary. A caveat when funding the trust with an existing policy is that if the grantor dies within 3 years of funding, the policy will be included in the grantor's estate regardless of who is identified as the current owner of the policy. So that's one of the tricks of using an existing policy. For additional considerations when doing funding, administrative items to keep in mind about making either a new policy gift or an existing policy gift. There's several items that you should keep into consideration. And as Emily mentioned, it's typically a grantor trust. So a taxpayer ID number may or may not need to be obtained. Typically with the bank, they want the taxpayer to have its own ID number. So I would say in most instances, I do see that insurance trust does have its own ID number assigned. The good news about that is the trust typically only owns life insurance and doesn't have an income tax filing requirement until such time as income is generated. The next item would be to open a bank account. We want to be mindful of where those policy premiums are being paid, and if they're being paid directly by the grantor to the insurance company, the IRS might take the position that it's still part of their estate regardless of what the structure is. So we want to make sure that a gift is being made to that trust and that a gift tax return is being filed. That leads into the next consideration for both types of funding, is make sure that the money is being transferred to that ILIT bank account, that appropriate gift tax returns are being considered and being timely filed, and that any necessary elections are being made. So some of you might be aware that when you make a gift to a trust, unless it contains a special provision, it's a taxable gift, which what that means is you're going to use some of your lifetime exclusion. And in 2022, that lifetime exclusion amount is $12.06 million. So there's this provision called a crummy power, and it's based upon the name of the person who, of course, the case was about, and it's kind of a weird word, but it's crummy with an EY instead of just a plain Y. And what that does is it allows the beneficiaries to be notified about their withdrawal rights, and it minimizes the tax implications of the gifts to the ILIT. So the crummy provision allows the beneficiaries the right to withdraw up to the lesser of their portion of the gift or the annual gift tax exclusion amount, which for 2022 is $16,000. So the beauty of that provision being part of the document is you can, I know that I have an instance where I have a family that has 16 beneficiaries, so they can have a pretty significant premium payment without utilizing, 16 times 16 is a pretty big number. So it's just a very good thing to consider. Moving on, other considerations for the planning or establishment of a trust and things that you should think about when you are considering this avenue. Each time that an individual makes a gift outright or for the benefit of someone else, there are gift tax considerations or consequences. For gifts to ILITs, there are several items to consider. One of them is that crummy right of withdrawal. And if that can be utilized, you will be able to make up to $16,000 in 2022. And we have, I know the IRS just put out that for 2023, it's going to be $17,000. So you can plan accordingly for your purposes. So that crummy right, what that means is, in simplistic terms, if you don't have a crummy right, then a gift of $5 or $50,000 will reduce your lifetime estate exclusion amount. With those crummy rights, then that $50,000 gift with 3 beneficiaries would allow for annual exclusion gifts of $48,000 and a taxable gift of $2,000. So it gives you a very different answer, having that provision built in. One last consideration for gifting purposes is if your spouse is named a beneficiary, then they cannot make gifts directly to the trust, but they can be part of the gift splitting. So the piece that's allocated to them gets carved off, and then the remaining balance of the gift can be split amongst the remaining beneficiaries. So if the spouse's portion is $5,000, for instance, and we go back to my $50,000 example, the first $5,000 would be carved off for the spouse, and the remaining 45 then would be split amongst the remaining beneficiaries. So you would be sitting in a pretty good position in this case. Finally, income tax consequences and considerations. If the ILIT holds more than a life insurance policy, then any income earned during the grantor's life will typically be taxed to the grantor. The trust is established as an ignored entity for income tax purposes, and that's what, when Emily was referring to a grantor trust, that's what she was talking about, is even though it's irrevocable, it's an ignored entity for income tax purposes, so the IRS isn't expecting a return for that entity. They're expecting the income to be reported on the individual's return. And then upon the grantor's death, so upon the grantor's death, if the policy is paid out, what remains in the trust will be owned by the trust. I think Emily alluded to the fact that if you're going to use this insurance to pay estate taxes, that you want to make sure that the life insurance trust has built-in considerations for loans to be made to the estate or money to be moved to the estate without jeopardizing the exclusion of this insurance policy from the estate. So as you can see, ILITs are a powerful tool and should be that could be a consideration for your estate plan. The experienced professionals at Belay would be happy to help ensure that your policy is used in the best possible way to benefit your family. As I mentioned at the beginning of the presentation, this presentation has been recorded and will be sent to you with a link. Additionally, we will send out a survey and would love to hear your feedback about that and any ideas for future presentations. Right now we have one question, and if you have other questions, please do type them into the Q&A item at the bottom of your screen. So the individual is asking, can you create an ILIT at a very old age and purchase the life insurance and still receive the estate tax avoidance benefits? Yes. At a very old age, typically your policy is going to be very expensive, and you need to determine if, you have to look at the whole estate and if that's going to benefit the whole estate. So yes, it can be done. I know that we have a few clients that have policies and they're in their 90s and they are pretty significant premiums. That's the word I was looking for. So if there's no other questions, that was the only question we had. If nobody else has additional questions, thank you for your time today, and we're glad you joined us.
Mm-hmm. And we're always happy to answer questions that, come up later. Our email and phone information is there on the slide. So feel free to reach out. I know there are a lot of various circumstances that apply to all of your situations or your client situations. So yes, feel free to reach out with anything that you.
Oh, there's one more.
Oh,
actually two more.
Okay.
One person asks, did you record and will this be on your website? We did record it and it will actually be sent to you if you were registered for the session. Mm-hmm. And then the next question, are there estate tax consequences of a large single premium?
But correct me if I'm wrong, but I assume they mean within 1 year, a large premium. And the estate tax consequence of that will depend on how that trust agreement is drafted. If you have a lot of beneficiaries with those crummy rights of withdrawal that Andrea was referring to, it's possible to have a policy that has a very large premium and split that amongst a number of beneficiaries, kids, grandkids, etc. So it is possible to get that, down under the annual exclusion amount and not use any of your lifetime estate exemption. And so that is possible, but the flip side of that would be if the trust agreement isn't drafted accordingly, you will have to use probably some of your lifetime exemption to apply to the cash gifted to make such a large premium payment.
So in my example, I said I had a client that has a lot of beneficiaries. I think it's actually 15, not 16, but their premium is $73,000. So even if they only allocated it to the kids, they wouldn't be using up their, and this particular trust does have crummy rights, so they wouldn't be using up their exemption, any of their lifetime exemption. They would be just making annual exclusion gifts. But it gets even drilled down even further, because we have, there's 5 kids and 11 grandchildren, and so it gets spread out even more. And that way the individual's able to make additional gifts besides the premium payments. That's all we have. Oh, so premiums are subject to the gift taxes. Premiums the premium itself is the total dollar amount can be subject to gift taxes. If you have, in this example, if you had a $73,000 payment and only 2 beneficiaries, then you would be using some of the exclusion. For this particular client, we do file a gift tax return just to prove that she hasn't exceeded her annual giving amounts. So we're doing that in that case.
Another way to kind of just rephrase, if that's helpful, to what Andrea covered is, the ILIT is the owner and beneficiary of this trust. It's supposed to be the entity making these premium payments. What is subject to gift taxes is the fact that the grantor typically gifts cash into this ILIT to make those premium payments. It's also possible to have assets in the trust that generate income to pay those premiums too. So that's not always the case. It just really depends on the structure of that trust. But that's what we're talking about when we say, contributions into the trust to pay premiums are then subject to gift taxes, because that cash that was transferred is a gift to the trust, since that grantor is not owner of that policy anymore. So hopefully that clarifies a little bit. All right.
I think that's it.
I think so.
Nothing else is popping up.
Yep.
Thank you. You're welcome. Thank you.
Thank you, everyone.
Thanks, everyone.